First, it was the COVID pandemic, then the return of inflation. Now, are banks going bad again? Financial markets scrambling to ring-fence the damage surrounding Silicon Valley Bank, SVB, a California lending institution favored by tech startups, whose seemingly safe bet on long-term government bonds proved a bust and triggered an old-fashioned run on the bank. We'll ask about the risk of contagion after the first major default since rising interest rates signaled the end of decades of cheap money. The 2008 financial crisis triggered a return of regulation, forcing big banks to keep more reserves in the vault. But was it enough? What's needed for money to make today's world go round? Will central banks continue to raise rates, coming out of a pandemic that's triggered mass layoffs in the tech sector? Who backs the startups of tomorrow? It's all happening as Europe scrambles to fund its energy transition and keep pace with the economies of the US and China. Finally, who guarantees that individuals, small depositors who need a loan for a business or their home won't be the first to suffer from all of this? Today in the France 24 debate, we're looking at the failure of Silicon Valley Bank. Joining us from Washington, Darrell Duffy, Senior Fellow at the Stanford Institute for Economic Policy Research. Thank you for joining us.
Nice to be with you.
Catherine Libonchitsky is Professor of Economics at Paris Assas University. Welcome to the show.
Thanks.
Jean-Edouard Colliard, Associate Professor of Finance at HEC, the Business School. How are you?
Very good. Thank you for inviting me.
And we welcome back commentator and entrepreneur Jakob Hessler. How are things?
Very well. How are you?
I'm fine. The France 24 debate. We can join the conversation on Facebook and Twitter, hashtag F24debate. Wall Street's nerves generally have steadied this Monday after Joe Biden's pledge to do what it takes to back up depositors. Still, though, many mid-sized lenders are having an awful Monday, chalking up huge losses after a weekend that first saw the failure of Silicon Valley Bank and then the takeover of regulators of Signature Bank, a lender for crypto companies. Jenny Shin has more.
It had a place among the top 20 largest banks in the U.S. until last Friday. Hot in demand as the banker to tech startups through the pandemic years, Silicon Valley Bank invested heavily in U.S. Treasury bonds when interest rates were low. When it suddenly found itself in need of cash after interest rate hikes by the U.S. Federal Bank, SVB was forced to sell U.S. bonds at a significant loss. Spooked depositors rushed to withdraw their funds, and SVB quickly collapsed. Experts say the bank raised several red flags before its demise.
The concentration in one industry, the explosive growth over the last year, they literally doubled in size from 100 some odd billion to over 200 billion in assets, catapulting them into one of the largest size echelon of banks in the U.S.
The developments raised the specter of 2008, when the subprime meltdown led to the financial crisis. In a speech to put out the fire, President Joe Biden reassured the nation that the situation is under control.
Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills.
Biden said he will also seek tougher banking regulations, vowing to bring those accountable to justice. But the events have already sent ripples through the financial sector, with bank shares in Europe and Asia sinking before the U.S. opening on Monday. Meanwhile, SVB has been put up for auction by U.S. authorities in hopes to avoid total bankruptcy. The UK arm of the bank is already being purchased in a rescue deal by British bank HSBC for the symbolic price of £1.
Darrell Duffy, this is SVB is a bank that had existed for 4 decades. Why did it suddenly grow like a supernova and then die?
Well, first of all, they had a tremendous business going in Silicon Valley. It was the go-to bank for tech firms. Each of the tech firms trusted that the other tech firms knew what they were doing. And you stated correctly in your introduction that they took a lot of risks by buying bonds. And those risks were not hedged. When the Fed raised interest rates, the bonds lost a lot of market value. And the savvier of those VC funds saw this coming and took their money out. And when they took their money out, the bank had to sell bonds at a loss. Then other depositors saw the same thing coming, and a classic run occurred, garden variety run.
A classic run. Catherine Luboshinsky, buying bonds, how boring is that? That's not a risky bet, is it?
Well, it is when you have short-term deposits, and then you invest those short-term deposits into long-term assets, and that's called maturity mismatch, and that's one of the main risks in banking activity that you teach to students in class 101, interest rate risk and liquidity risk.
So how did this happen?
Well, I don't know. They just decided to invest the extraordinary increasing amount of deposits that were made at that bank into safe assets, as you mentioned it, but safe in the sense of default risk, and long-term assets in order to increase the net interest margin, because you get higher interest rates on long-term assets than on short-term assets. So therefore, when interest rates increased, their duration was high, not on those T-bond they sold, it was only 3.5, but on the rest of their assets, it was about 6. So when interest rates go up, they lose money.
Jean-Edouard Colliard, television's a stupid medium. To put it simply, they didn't see inflation would come back?
That's a good question. So, whenever you have a banking crisis like this, I totally agree that there are several elements of a banking 101 course, right? So you have maturity mismatch, maturity transformation. You have a very classic bank run. These are things that people should see coming. And so then the question is always, did they not see this coming, or did they not want to see this coming? Maybe they were betting consciously on interest rates, being lower than what the market expected. That's also possible. How did the supervisors not see this coming? Maybe that's something we will discuss at some point. So, yeah, that's always a puzzle at this stage of a banking crisis.
There's supposed to be more supervisors, right?
Well, the bank was not part of the top tier of supervised banks. So it wasn't part of the stress testing, and it wasn't part of the stronger Basel regulation. That's the first one. The second is
Basel regulation, meaning
an international regulation about
where you have to put a certain amount of your money in the vault and keep it.
It's not only in the vault, because you could argue the money was in the vault. The problem is you couldn't access it. The money they invested was invested in really the vault, US stock treasuries. But you can imagine it, since you say television is a stupid medium, imagine you get this money from the people, they for the moment don't need their money. They say, I'll put it there, I'll park it there. And you tell them, sure, you can get it out anytime you want. But in fact, you take this money and you put it in your vault. But your vault has a time lock. And the time lock is 5 years. And you put too much of the money that you're given in this vault. And now the people come and tell you, actually, I need my money back. And you say, can you not wait? And you say no. And then if they want to open the time lock, they need to pay a price. And that is what created the problem.
Darryl Duffy, you heard there Jacob Hessler saying this bank was, I think, the 16th largest in the U.S., wasn't subject to those stress test rules that were reinforced after the 2008 financial crisis. Should it have been?
I would say so. There was a move in 2018 at the Fed to go lighter on these medium-large banks. That was pushed through, and I think that was a mistake. And I think there's going to be lots of questions asked now about that, and also not only about the regulations, but about the supervision, as one of your guests also said. Somebody should have been paying closer attention, because even in February of this year, in their public disclosure to the Securities and Exchange Commission, they showed very significant losses on those bonds that we've all been talking about. So it was apparent at that time that they needed to raise equity capital, and yet that didn't happen.
Though they tried. In the last minute, on Thursday, they were trying to raise $7 billion with the help of Goldman Sachs. And as the bad news come in, that deal collapsed. So when this was announced in February 15, it was a big article in the Financial Times, actually, that actually described how people were actually taking active bets against the bank, buying, short selling, in other words. They say if the stock goes down, they'll make a lot of money. In other words, thereby pushing it down. And That's what happened. And so the bank reacted, but it was too late.
In that sense, the fact that there wasn't enough oversight, as stated there by Darryl Duffy, Catherine Luboshinsky, is this a repeat of the mistakes that we saw in 2008?
Not quite. I mean, the regulation was not as stringent as it is now, at least for European banks. In the US, medium banks, which is defined as less than 250 billion of assets, I think, are not subject to all the safety nets as liquidity ratios or...
And here in Europe?
Excuse me?
Here in Europe?
Oh, they are. They all are. They all are. They all use Basel III liquidity coverage ratio and net stable funding ratio, which they don't in the US.
Darryl Duffy, why not?
Well, those medium-sized banks do have to meet liquidity coverage ratios, but the degree to which they have to meet capital requirements, the stress testing, it's just not as big. The largest U.S. banks, the household names like J.P. Morgan Chase, Morgan Stanley, Bank of America, Citibank, Goldman Sachs, Wells Fargo, these banks have to meet even more stringent capital regulations than the largest banks in Europe. So it's a question of were the mid-sized U.S. banks put under enough regulatory pressure? And apparently the answer is no.
No.
And it brings up another question, which is that what the role of this bank was. It made a poor investment decision, a poor bet, as you heard our panelists say, but it played an important role. It's far from Wall Street. SVP catered to California's thriving tech sector, be they tiny startups or big names like Roku, the makers of popular TV and video streaming devices. They had nearly $500 million in the bank there. And Etsy, the e-commerce company that trades handmade and vintage items. Now, we heard announcements by the U.S. president. Are those companies going to get their money back?
Yep.
So apparently yes, and so that's quite surprising. So in principle, these deposits are very large. Many of them are very large deposits that are way above the regulatory limit of $250,000. So they should not be insured, but systemic risk exemption, in order to not have contagion to the rest of the U.S. banking system, the U.S. decided to actually extend deposit insurance, which had already happened for money market funds in the U.S. during the past global financial crisis. So those things, are not
Is that a good
totally
thing?
unprecedented.
Is that a good thing?
I think the problem with all these banking failures is that once you have a too big to fail or too many to fail crisis, once you are in a position where you can't really let the system melt down, it's already too late. You know that bailing out and not letting uninsured creditors take losses is bad, but the alternative is worse. So that's why it's very important to prevent those things from happening ex ante. What is a bit of a shock is that I think there was some consensus, maybe I'm being too optimistic, but actually Darrell proved this statistically even. There was some consensus that too big to fail had decreased a lot because of post-crisis regulations. And so seeing, as quickly a new banking crisis with regulators, the Fed, the US government stepping in, insuring deposits, exposed and so on, that's a bit shocking because I think the consensus was that those things were over. And so it's not as dramatic as what we had in the 2000 crisis, that's for sure. It's much more, probably no taxpayer money involved and so on. Still, it's pretty bad news for the credibility of these new regulations, I think.
Catherine Luboshinsky, are you shocked?
No. I just might want to add the small differences between now and during the global financial crisis is that banks were bailed out and creditors, investors in the bank were helped out. So you could say socialize the losses. Here, it's just the deposits that are going to be insured.
But these are very large uninsured deposits, right?
Yeah.
So I agree it's one step below,
but you have
the
another
equity holders
issue.
can lose everything.
You have an economic issue in terms of the tech startup ecosystem. And if you don't insure all their deposits, then they're going to have, as companies, liquidity crisis and paying their employees or anything. And I think that's what they want to save, not the bank, but the startup ecosystem.
Let's talk about that for a second. The Reuters news agency spoke with the founder and CEO of a company called Lingumi. That's a UK startup which helps children learn languages. Here's what he had to say.
It certainly taught us a lesson about how we manage our cash. But when you're a small startup, especially early on, you don't have the team resources to balance your cash across multiple banking products. And the one part of a startup you expect not to go wrong is a bank. We take a lot of risks as entrepreneurs, but we expect our banks to be stable.
And just to go a little bit further on that, Jakob Hessler, the Financial Times quoting the partner at a venture capital fund is saying, before SVP sprang to life, it was difficult, if not impossible, for a startup to secure a relationship with a large established bank.
It is still complicated because the hurdles for opening accounts are complicated. But even today, if you have a minimal of funding today in countries like France, of course you can open a bank account. There's no problem.
And it isn't this, because break the myth here for us then. Tech startups, you're trying ventures, you're trying stuff, you're taking risks when you're.
Yeah, but you're not.
These are new fields, and so
but there's a whole different.
You need
world,
risk takers on the financial side.
The bank in this case is not a risk taker. See, it's not that that's another, and I think Catherine mentioned there's a fundamental difference between 2008 and now, which is 2008 the assets that the bank has invested in were bad. It was bad real estate loan. Here, the assets are fundamentally good. It's U.S. Treasury bonds, the most boring of assets you can imagine, except that their duration doesn't match when the customers want their deposits. These banks, what we're talking about banking relationships, is not get a credit at the bank. Yes, that remains very difficult, but that's precisely the reason startups get money from VCs. But the VCs, let's say, venture capitalists, they give you, let's say, 10 million. You're not going to spend all the 10 million, so you have to put them somewhere. So you put them on a bank account. You put them on a bank account and you draw down to pay your salaries. And then the bank takes this money that you give them for the time being.
All right, so following up from what Catherine said, the failure of VCB, what impact does that have on Silicon Valley?
Well, since they save the deposits, the impact on the startup scene for now will be not major, because everyone will get their deposits back. And given the treasury skills they had, i.e. they put all the money in a single bank, even if it was 500 million, which seems odd. But the real effect that we need to discuss is whether there's a second order ripple effect. Because what will happen is that in order to continue to attract deposits, banks will have to pay more. So they will have to pay for the fact that if they get higher return for longer, they have to pay more. So the margin will go down on that side. And on the other side, in order not to overexpose and create more of these losses, the rate increase may be lower. And then the combination of the two will mean there will be less credit.
Darryl Duffy, when you teach at Stanford, you can see Silicon Valley from your window. Can you tell us, will there be that ripple effect that Jakob is wondering about?
Well, I do think that tech firms are going to have to, first of all, re-examine their financial practices. Normally, as your guest said, they don't even think about the risks of putting money in bank deposits. That's considered the safe option. And now they have to rethink how they're going to do this. They also have to establish new banking relationships for credit lines, for loans, for securitization, for assistance when they go public with the banking side of that. So this all has to be re-engineered, and I'm sure there'll be other entrepreneurial banks that will step in and try to take some of this business. Apparently, it might not be preserved as an ongoing business, and that would be unfortunate for those tech firms. But now, as has been said, now that they've got their deposit back, at least they can make their payroll, at least they don't have huge financial losses, and I think the tech industry will be fine.
The tech industry will be fine because it will always be backed by the government. I asked the question because you penned a piece for CNN where you said, Darryl, that the tech sector is an engine of economic growth and a key element of U.S. national security, especially given the rivalry between the U.S. and China.
Absolutely. And that's, I think, one of the key elements of thought in the government to protect the depositors in this particular bank. if the tech sector had not been saved, as I understand from a Reuters report, close to half of all listed tech and healthcare startups and VC funds had banking relationships with Silicon Valley Bank. Had many of those firms been unable to continue business, then the entire tech sector would be threatened, and the United States is in the middle of a very tenuous rivalry with China over tech.
A rivalry, I note that you say with China, you're not including Europe in that. We've been bemoaning the last few days. We had the President of the European Commission going to the White House last Friday because of the Inflation Reduction Act, trying to, financing how you do this energy transition. Europe feels a little bit left out of the equation. Does the European Union have the backs of small startup entrepreneurs of the tech sector the way the US does, as described by Darryl?
It's a good question. I think we have a banking system which works very differently from the US banking system. We have the financing of startups works differently. We also have a market which is much more fragmented, across the European Union, with some large banks in each country, and many of them, funding startups and so on. So we don't have the
top-down approach.
Yeah, we don't have the type of concentration that there was at SVB in particular, right? So what's very, very special about SVB, it had a very particular balance sheet, right? In particular, on the liability side, a huge amount of uninsured deposits coming from all these tech firms. You don't have the equivalent of this in Europe, okay? Because the startups are typically funded, but even if they are funded by banks, then this is by universal banks that have a very diversified liability side, a lot of insured deposits that are not repriced as frequently as uninsured deposits. So I think the issue, I think there are a lot of issues potentially with Europe. Maybe we are going to talk about them later, but not exactly this one.
Jakob Hessler, do Europeans, do the French, do the Germans consider the tech sector as something of national interest?
I think they do. But I think it's not at all linked to this banking issue. I think if the same situation had happened in Europe, they would have bailed out the depositors exactly in the same way to protect the tech industry. I think, obviously, this was the thing to do. That doesn't mean that in the rivalry, or however you want to call it, to attract money for mostly, energy transition, etc. I'm not so sure this is just a boon for startups. This is particularly a boon to attract large, massive, classic industrial companies. It's about Volkswagen going to the US or not, they're going to Canada to build batteries. I mean, this is not, the Inflation Reduction Act is not specifically a startup measure. It's a measure to attract investment and to make overall a jump ahead in infrastructure for energy transition, while also hopefully having some inflation reduction impact.
Doing that transition, though, in the digital age, and when you look at the biggest banks in Europe, they've been spooked by the events across the Atlantic. 3 of Italy's top 4 banks, Unicredit, Intesa Sanpaolo, Banco BPM, the deep in the red all day at the Milan Stock Exchange. The Milan Stock Exchange, which finished the day down more than 4%. Italy particularly battered, Catherine Liboczynski. Is this for domestic reasons, or again, is this linked to what's happening in Silicon Valley?
Well, are you pointing out the difference with the French banks? Because some of the French banks drop also, their stocks drop by 6% the same way. Yeah. The major difference between Italy and France, for instance, is the public debt size, which fragilizes the capacity of the government to step in case of a big bank crisis. But I think that would stop here. Yeah. So I don't, maybe you want to.
Yeah, can I jump in on this? Yes, so an interesting difference with Italy is that in Italy, actually, a lot of mortgages are actually variable rate and not fixed rate like in France. And so actually, the maturity profile of the asset side is very different. So if anything, you would think they are less exposed to these kind of things. So what I find very puzzling is that, we could say, well, this is a supervision issue in the US. This has nothing to do with Europe and so on. It's quite puzzling.
That's what ministers have been saying all day.
Yes. At the same time, it's quite puzzling to see that markets are not convinced at all. So personally, I think that indeed I'm not particularly worried about the fundamentals of European banks. I think that interest rate risk in the banking book, sorry, it's a technical term. So this type of risk that we just discussed is taken care of by European banking supervisors in principle, but markets are not convinced at all. And I think that by itself, this is already a failure of our regulation, that one thing you would expect from banking regulation and banking supervision is that it's credible. It's one thing to do your job properly. In banking, it's very important that everybody is convinced 100% that you do your job properly. The reaction that we see in European banks today tells me that investors are not fully convinced, and this should trigger a little bit of soul searching.
But that would imply that you think that the slight, you could say it's a loss, 6-9% loss in banking stocks is due to a misperception of regulatory work. It could also be that there is a repricing because of everyone now assumes that the Fed will not raise the rates as much, and that will have an impact on the economics of banks.
Darrell Duffy, this is again one of the central issues, which is that the era of cheap money is over, inflation is back, and we're still not sure how to factor it?
I think markets have already spoken. They've suggested that the Fed is less likely, as of the fall of SVB, to continue to raise rates. But when we look at the bad returns on European bank equities in the last couple of days, I think it's a situation in which, as is often said, equity market investors can really only focus on one thing at a time. And when they see this big failure in the United States, as all your guests have suggested, due to simply rising interest rates and a duration mismatch between assets and liabilities of the banks, where the assets go down in value and the cost of keeping deposits goes up, people suddenly realize, wow, this is not a phenomenon, rising interest rates, unique to the United States. It's been happening all across the world, including Europe. And investors may be saying to themselves, let's have a look at European banks and see if they have to pay more to keep their deposits, and see if their long-term assets, some of them, have gone down in market value. And once they start asking those questions, the uncertainty drives the stock prices down.
So, Catherine Luboshinsky, if they now ease off on raising interest rates further, what does that mean? What does it?
No, I don't think. I don't think that the ECB will ease the increase of interest rates, because inflation doesn't go down as quickly as we were expecting it to go down. So I don't see the ECB reacting like maybe the Fed will react by easing their interest rate increase.
And when I say easing in the U.S., instead of
raising
half
less,
a point, it'll be raising by
25%,
0.25%.
Yeah. That's also what I meant. Yeah. But that is very much linked to how is an underlying inflation going, and I mean, people are getting a little more hopeful in the U.S. than in Europe, because in Europe we have our energy prices that are still high. So we might have second-round effects, still not there, but we're afraid they'll come back. So I think that there's some asymmetry on the interest rate policy that the Fed can have and the interest rate policy that ECB will have. That's the major difference. I don't think what happens to SVB will impact the Fed interest rate policy. I don't think so. But I might be totally wrong.
Darrell Duffy, you agree?
No, I think the market was assuming between 50 and 25 basis points before SVB fell. That is, that the Fed would, its next raise, which would be next week, would be between 25 basis points and 50 basis points. Now I think the markets are reflecting perhaps between 0 and 25 basis points. So I do think it's had a temporary effect. The Fed's not going to let off on inflation. It's going to control inflation by raising rates as much as necessary, but it's going to pause with some probability. It's going to pause increasing them at the speed that it has been. And I think we do see an effect, at least in the United States, from what's happening not only at SVB, but at other banks as you've been seeing in the news, there are several other banks that are caught up in this, having depositors leaving and causing them to have to raise cash in a difficult market.
All right, that's when you look at one aspect, which is the perception of this from investors, the perception of it from banks, from businesses. The other is the perception of this from voters. The U.S. president is slated to announce that he's going to run for re-election very shortly. And Joe Biden has to walk a tightrope between progressives resentful of bank bailouts and who cheered the Occupy Wall Street movement a decade ago, and all those voters in 2016 who wanted Donald Trump to, quote, drain the swamp of collusion between Washington politics and high finance. The U.S. president fully aware of that when he spoke earlier from the White House.
The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Yeah, did you have the sense, Darrell Duffy, that there was sort of this ghost of 2008 in the room?
An elephant.
Well, definitely President Biden wants to guard against any sense that taxpayers are going to be compliant with these bank failures. He wants to get to the bottom of what happened, and he also wants to assure Americans that this is not acceptable and that investors should be forced to take these losses. He did not mention that the unsecured depositors are a form of investor that will be protected. Now, the money is going to come from the banking industry, at least at first. So in that sense, the taxpayers are not on the hook. But there is a mini bailout of those unsecured depositors, and I think it's necessary to do it at this point in order to nip the bud of any potential wider run on banks.
He didn't mention it, but Republicans already have a potential candidate, Ron DeSantis, calling SVP a woke bank. What were your thoughts, Darrell Duffy, when you heard that?
I didn't see that comment, but I'm not that surprised to hear that from Governor DeSantis.
Jakob Hessler?
Well, I'm struggling to figure out what a woke bank would be in this contest, so I can't really comment.
But is it again? Is it going to be pitted? And this could frame the conversation about again this idea of working people versus elites somehow.
Well, I think if they manage to carry through the fact that equity investors, the rich people who own the bank, are paying for their bad investment, whereas the companies that employ all these young Americans that create value and technology for the future of the nation are being protected. And if they can get that scenario across in a credible way, I think he's fine. If, however, it seems that the people who have the deposits are not seen as the companies that create America's future and defend the national interest in the rising power struggle with China, but are just crony companies of digital, doubtful, etc., then obviously the narrative wouldn't work.
Catherine Luboshinsky?
I just wanted to make a point from President Biden's speech where he pointed out that top management will be accountable for what they did. And I think that's going to be the first real time if it happens. And that's a new trend in finance where there are papers saying that top management has to be accountable if something goes wrong. It's with the ESG also criteria that goes along with top governance, with the governance of companies that has to be implemented.
The resentment of banking, the resentment of bank bailouts past Jean-Edouard Colliard, is it as strong here as it is in the U.S.?
Probably yes. I mean, we have seen a lot of complaints after, 2008 and the sovereign debt crisis in Europe, about bank bailouts, about cheap money for banks and so on. So the communication of all this is always extremely complicated. And so this complicates the job of central banks and the job of regulatory authorities, that's for sure. So, at the end of the day, someone has to pay for these losses. And unfortunately, it's always people. Okay, so even if we frame this as saying the banks are going to pay for other banks, well, first, it's not clear it's fair that, cautious banks pay for risky banks. But those banks, they are going to pass the costs on to consumers or to their shareholders. Ultimately, these are people, right? So, there is a whole political economy element here on, who is paying for what and how do you manage to frame who is taking the losses. This is really important, but it's really a communication story, basically. And so on this, it could go in many different directions. So, one pitch basically was proposed by Jacob. This could go in different ways, and so that's really the art of communicants, I think, to think about this.
All right, how to communicate this story. The U.S. president blaming Republicans for weakening regulation and legislation back in 2018. There were Democrats, by the way, some of them who voted for that weakening. We see progressives like the Massachusetts Senator Elizabeth Warren calling for more oversight and complaining about the weakening of the financial rules. Darrell Duffy, again, as you've just heard our panelists here on set say, it's about how you frame the conversation. For Joe Biden, does he have as much of a problem from his left wing as he does from his Republican opposition on this?
Well, I read the editorial this morning in the New York Times by Senator Elizabeth Warren. She's very disappointed. She's adamant that regulations were not done well enough, but she did place a significant amount of the blame on changes that were made during the Trump administration. The left in the United States is definitely not at all happy about banks getting this kind of support from the government. But on the other hand, if you had allowed tech firms to fail and possibly allowed a bank run to get rolling, then I think the left and right would say that should have been stopped earlier. So I think in general, there's going to be a lot of blame placing, and as has been said, this part is all communication. It's not really as important as fixing the problem.
Yeah, because I want to emphasize this point.
There is some left versus right, but that's normal in American politics.
I want to emphasize this point. What's the perception of, we've talked about the perception of bankers among U.S. voters, but what's the perception of the tech sector?
I think it's, generally speaking, viewed as a jewel of the United States economy from all sides. Now, there are, perhaps Governor DeSantis might not think much of the San Francisco culture, but I think if asked whether he would like to have a Silicon Valley in Miami, I think he would probably say, yeah, absolutely, that's what we're trying to do in Miami.
He's trying hard to get one, Jacob.
Well, I think Florida has been trying to lure tech companies from the West Coast and banks or financial institutions, asset managers, investors from New York to Miami. So very clear they'd love to have one. And I think it's a myth to think that tech in the U.S. only happens in Silicon Valley. You have it on the East Coast. You have a huge tech space around Washington, D.C. in Virginia. You have it in Texas. You have it. I mean, it is much more widely spread than we commonly assume. Yes, of course, there's Silicon Valley, but it is. Everyone has a share in it now, and usually people want to have more of it.
Jacob has to, again, uncertain times, rising inflation, the jitters that we've been talking about this whole hour over the financial sector. What about risk taking? Because that's what we're talking about when you talk about the tech sector. Is risk taking impervious to whether the economy's up or down?
I think complicated to say. I think risk taking, we need to distinguish a lot between the question of how do we manage the systemic risk of an economy that has banks, it has lenders, it has investors who invest in companies, in stocks of very small, high-risk companies that may fail, or in very large companies that have a less of a risk to fail. And I think the appropriate reward for taking risk and making sure that that works is part of what makes the system going. So that if you invest in lower risk, well, you get a lower return, and higher risk, you can get a higher return, but you obviously also have a higher loss. And this, one of the issues is, of course, when the people who take the biggest risk, when the loss materializes, manage to have it socialized. And that is what I think is called moral hazard, because if your neighbor's being saved once for being risky, you're going to say, you know what, I'm going to be just as risky, because when the whole thing goes bust, someone's going to come and bail me out. And they are probably right, except that in this particular case, and I want to state that again, this was not about neither the startups taking undue risk, they were just maybe naive and bad at treasury management. The bank was a bad risk managed bank, but they weren't trying to do anything super risky. They were just incompetent. And the match of the two led to this implosion of Silicon Valley Bank. And it's so surprising because we associate Silicon Valley with high degree of sophistication, very clever, intelligently acting people. It turns out that the boring part of banking has brought this thing down, and not the fact that what they invest in is super high risk startups.
It sounds a bit like a perfect storm, Katrin Luboshinsky, or is it? Or is the banking sector more brittle than we think?
No, I wouldn't say that much. I would emphasize again that it was a specific bad risk management from the bank, which, by the way, I think didn't have any chief risk officer for the last 6 months, but that doesn't help. But I think it was really typically bad risk management for this bank. End of the story. Now, I would like to remind you that when you finance innovation, you do take risk. The question is, should banks be taking the risks, or other institutions, like in Europe very often, or in France? It's more or less public or international institutions like the BEI or the BPI in France.
BPI, which is the Public Investment Bank.
Because they don't have any short-term constraints on their liability side, so they can take risk, can make investment, and wait several years before it becomes profitable. So the question is, should banks be taking that kind of risk, or should it be other specialized institutions?
Banks, individuals, or the state, as just mentioned there by
No, not the state directly, indirectly.
well, state-backed, shall we say. Your thoughts on this?
My thoughts on this. So usually, I'm a believer more in market solutions to this, and I think they are pretty good at financing innovation. This being said, I think that a lot of this bank is very, very idiosyncratic. So here what we have is a bad business model in which you have all these bonds, that's one thing, but they had also more than 70 billion in loans, in particular to tech companies and VCs associated to the tech sector, and they were taking deposits from the same sector, okay? So it's a lot of concentration of risk. So, it's a market-based solution, it's a private company, but it's definitely a company that was not doing the right thing and did not have the good business model, okay? And so I think that's relatively, to me, that's relatively idiosyncratic. I would much prefer,
Europeans who are playing catch-up on innovation, how much risk do they take and how do they take it? That's the question.
So I think Jacob would be in a better position to answer you. Probably.
I think we have in Europe a striving venture capital scene. It is ironically very often capital that comes from U.S. investors. So when you look at really who provides the money to European venture capital firms to invest in European small firms, it very often is money from, let's say, the Milwaukee Public Workers Pension Fund, and not money from European investors. The reason for that is because European investors are, in general, they don't like to take as much risk. So they will only invest in American venture capital firms in America, if at all, and very, very little, whereas the Americans tend to be more adventurous. They take more risk. And I think the key to funding innovation is that it's not bank finance via debt, where you secure your credit with something that may not even exist anymore. And if ever the company is successful, you still only get your whatever X% your loan provides. And you take a huge risk. So in that sense, equity shares, it's the much better instrument because if you really create value as a shareholder, you participate in it, well, and you take the risk. If you don't, well, then you lose, which in fact I think is going to happen to the shareholders of SVB. They're going to lose, the shareholders in the bank, they're going to lose money, and rightly so. And the management, I think you absolutely said, will probably be fired, or if they haven't already been.
So a little bit of a bailout, but not too much. One of the lessons of 2008. I want to thank you, Jakob Hesse. I want to thank Catherine Luboshinsky, Jean-Edouard Colliard, Darryl Duffy for being with us from Washington, D.C. Thank you for being with us here in the France 24 debate.
Victims of rape.